first idea, Abbott Labs.
Yeah, so this is a diversified healthcare company, very global. About 55% of their revenues are outside of the United States. They have 4 operating divisions: medical devices, diagnostics, established pharmaceuticals, which is essentially generic drugs that they sell to emerging markets, and nutritionals. Some of their brands in there is Simulac and Ensure, which your viewers might be familiar with. So Abbott Labs benefited during COVID because they did all those testing kits for COVID. And obviously now with the advent with COVID behind us, those sales have been dropping dramatically. But their base businesses are growing very nicely. In fact, when they reported last week, they're all growing organically, double-digit in terms of top-line growth. They have one particular product, Freestyle Libre, which is the glucose monitoring system, which is a patch. And there was some talk that, with everybody on these weight loss drugs, that the diabetic population was going to go down dramatically, and that would impact Abbott's business. And in fact, Abbott's done some studies which shows that patients who are taking these weight loss drugs, in fact, are also using their product to monitor their glucose levels. So, the CEO was actually did a very good explanation of what the targets are. It's very premature, I think, to assume that, and they're showing that they're still experiencing very good growth. So we like their diversification, we like their global aspect. 51 years of consecutive dividend increases as well.
JPMorgan would be one of your favorite banks.
Yeah, so that is the U.S. bank that we own. We think big is better in this environment. They obviously are the largest bank in the United States and one of the leading banks around the world. Number one in terms of consumer deposit share. They have an 11% share. And if you recall, typically in a normal environment, regulators will not allow JPMorgan to buy any financial institution. Any bank that has more than 10% of deposit share is too big, and they don't want them to grow. But as you recall, Andy, they actually bought First Republic back in May. First Republic was a bank that was
kind of a rescue
effort. 4 banks bid on it, JPMorgan being one of them, and they won because they had the strong balance sheet, they had the scale, and First Republic. Very, I think, attractive acquisition, very creative, targeted a high net worth individual, so that expands their presence there. And I think that it's going to pay off longer term. I mean, it is creative. The government regulators are actually giving some a kind of loan loss sharing program, so some protection there. So it was actually a very clean bank. It was just because we all know what happened in that regional banking crisis. So that was very good. So I think, and the big banks are benefiting from the volatility we're seeing in the smaller regional banks. So, and we like the CEO, very respected, Jamie Dimon, and he worries a lot, so we like that. And we think their provisioning is quite conservative.
You like a bit of a worrier. You don't want a guy complacent, I guess.
Exactly.
Thermo Fisher Scientific is your final idea.
That's right. So it's the leading global player in life science and tools. So they provide drug companies, pharmaceuticals, labs, anywhere from drug development, very early stage, and they can provide all the tools necessary to bring the drug to manufacturing, to monitoring. And once again, Thermo Fisher also benefited with COVID testing because they got sales from that. So that is tailing off. But right now, the overhang on the stock has been that there's been weakness in China, which is about 8% of their revenues, as well the biotech, their end market biotech companies, less funding opportunities because there's no IPOs, higher interest rates is kind of restraining some investment growth. But we think that's a short-term headwind, and we think longer term this is a very attractive area. They in fact actually got a manufacturing contract from Novo actually to manufacture Wegovy, one of their weight loss drugs. And so we think that they're kind of vital, critical to the pharmaceutical industry, and that they help them with their drug development all through their clinical trials. And what they provide is very key. We like the management team. They've done numerous acquisitions to grow their presence in the space. So I think the pullback in the stock represents a very good attractive entry point.
Apparently they just bought a company for $3 billion plus called Olink, to make them even bigger in protein analysis. I imagine that's fooling around with DNA. And
I mean, they're pretty well have spread themselves anywhere. They're in very, very different segments now.
Christine, thanks very much indeed.
You're welcome, Andy.
We are out of time on Market Call. Thank you very much indeed. Okay, let's have a look at those top picks. First off, you're sticking with the US dollar. You think US currency goes higher?
Absolutely. And again, we see it literally every day. I mean, the euro-dollar market is wobbly. Everything is literally wobbly. Everyone sees inflation. I see deflation, as a matter of fact, and I worry about deflation. I mean, I walk along Yonge Street all the time, and probably in the last 3 years, 50% of all the stores are boarded up, et cetera. That's deflation. So again, this U.S. Treasury trade has been painful, but if you do it in proportion, the way I'm suggesting, so come December, as I said previously, I'm going to basically sell some of my gold and equal weight those two asset classes being the TLT and the PHYS. And
Sure.
So again, year to date, we just did the review. I'm up 3%. I protected my capital. I'm ecstatic by that. I want to keep my level of wealth in the market no matter what happens during this financial repression. And I think that strategy helps you out a bit.
Okay, and then another side to the coin here is you think long bonds look decent here, TLT?
The TLT, same issue. I mean, they've been really hurt. But gold, year over year, it's up 21%, which really helps you out on your TLT trade, right? So again, but again, come December 31st, I'll equal weight both of them. I do have losses in my TLT, take my gold and balance them out, then face 2024 with obviously a big chunk of U.S. dollars and that U.S. dollars in both the TLT and the PHYS.
And then finally, you are sticking with Sprott physical gold as well.
Again, I've looked at it. You don't want paper gold. I mean, that's what the GLD is about. I'm very comfortable. It's in the Canadian Mint. It's supposed to be segregated, and it trades in the U.S. as well. So if you have U.S. dollars, you can buy the PHYS as well.
Brian, thank you very much indeed.
Andrew.
Brian Acker, the one and only. First idea, Oracle, and this fits with your thesis that the software people will benefit from AI in a big way.
Yep. Oracle's, it's both a hardware and a software, although it's sort of rotated more into the software a little later than people sort of wanted. But I just want to go back because I was looking the previous caller
Sure.
Asking about Salesforce, and I'm sorry I didn't give you our price target. Our price target on that was 243, and I think it was sitting right around 200. So anyway, back to the top picks, Oracle. So, this is one of the big guys. It's 280 billion market cap company, currently trading right around 101. And it has a decent runway going ahead. So we have a 12-month price target of $126. So Oracle, it's interesting when you're talking about the services and the hardware versus the software. So they have sort of three business units, which is the cloud and the licensing. So they're sort of the number 4 horse in the race in the cloud. But then they have sort of a lot of legacy hardware side, and then the services is very much where they've brought in, where they've come in with more products. One of which, it's really interesting, they just came out earlier this month with this Oracle NetSuite, which is integrated generative AI capabilities. It's powered by the Oracle Cloud infrastructure, but then this feature called the NetSuite Text Enhance enables users to create and refine contextual and personalized content by leveraging all the company-specific data in that Oracle cloud infrastructure. I'll give you an example. So for example, like in sales, it will help create contextual email responses by using that ERP, Enterprise Response Planning, and also CRM, Customer Relationship Management, and supply chain data. So they have the data. You go in, you ask the questions, almost like a chat GPT, but you access all of the data coming out of the infrastructure over at Oracle. So I would definitely, we own this. I'd own it here. If you get a chance to pick up another third down around 97, another third down around 91.
Lam Research is your next idea.
So this is on, this is again a semiconductor, but it's a semiconductor equipment company out of the US. So it is actually going to be a beneficiary of that CHIPS Act that came out, but it has a it specializes in designing and manufacturing semiconductor processing equipment, essentially for integrated circuit fabrication. So currently trading right around $600. We have a 12-month price target of $680. Could talk a lot more about it. If anyone wants to talk more or hear about this, just give us a shout over at Black Swan. So I don't hear. I think you probably may get a chance to buy it down around 570, and if you're lucky, down at 540.
And Atlassian is the last one. Team is the symbol. A software company.
Yeah, it's an interesting software company. It's so it very much caters to developers. So it's not like for everyday use and so on. But it provides solutions to enhance productivity, particularly for technical and business teams and developers out there. And the company sort of has three sort of business lines: project management, collaboration, and then software development life cycle tools that they talk about. Great total addressable market. They've come out with these Jira, J-I-R-A products. They just bought a company called Loom, which is a video messaging platform. So you can see how that could actually be used in a business setting. And it's, instead of actually using like a Zoom or Slack out there, you can actually get into Team and you get your own video messaging group. And so buy it here around 187, lucky if you get it down at 177, and then 167 for the final third.
I don't know, Kim. I don't want to be getting video messages, though. I mean, I want to read an email. I don't have to wait until somebody winds up with their video. Or maybe I'm missing the point.
Well, hey, look at TikTok.
Yeah.
Right?
Yeah.
And then another very cool video servicing out there. I don't know if you've ever used it, but Telegram. Telegram just came out with a very cool video messaging thing that actually comes. It's sort of like a porthole. So it's just very different. And actually, the Telegram one has a 15-second life cycle in it.
Oh my God, and then it's gone.
And then it's gone.
Into the ether. Oh,
Yeah.
Thank you very much, Kim.
All right, thanks, Andy.
Let's get to those top picks. The number one idea is Alphabet. The market wasn't delighted by weakness in their cloud division.
Yeah, they actually reported their results yesterday, and to our assessment, the sales and earnings look pretty good, but there was some disappointment that the cloud business had decelerated 1 or 2 percentage points to a still very respectable mid-20s% growth rate year over year. But we think the sell-off in the stock yesterday was wildly overdone and is sort of emblematic of changing and shifting sentiment in the market, particularly towards some of these big bellwether names, but fairly recent addition to our momentum mandate. We like Google because it's the undisputed leader in online advertising. with a pretty unique business model. It's a pull strategy with their search engines, and that would contrast with some of the social media platforms where it's push advertising. So Google obviously has a wide and deep moat. It's driven by the network effect, not only with search efficiency, where it's got an 85% or so market share. It's challenging to even name more than one or two other competing search engines. But apart from the search engines, there's YouTube, and you talk to a Gen Z or even a millennial, like my teenage son, just try and pry YouTube out of his hands. It's nearly impossible. So YouTube is a dominant force in content creation and consumption. It's also got the dominant operating system, Android, and then Workspace, which used to be known as the G Suite of products, so Google Docs, Google Sheets, Google Slides. And all of those are driving adoption of their cloud services, where they're admittedly a distant number 3 player behind AWS, Amazon, and Microsoft with Azure. So we do think the company is benefiting from market share gains across their businesses, but also, more importantly, long secular trends away from traditional advertising and towards online and cloud computing. But in particular, their leading position in generative AI should be an even greater kicker, and allowing for better monetization of their data as it becomes more valuable over time. And right here, right now, we do think the company is in a pretty sweet spot in terms of its earnings momentum, as it's got some pretty easy comparisons with a year ago out over the next couple of quarters. And even after that lapses, it should be able to sustainably grow earnings at a high teens pace. So trading at 18 times earnings, very good combination of value and growth here, and a real market leader and bellwether, and name that we're happy to have recently added to portfolios.
Intact Financial.
So another leader, entirely different sector. This is the biggest property and casualty insurer in Canada with a 20% market share. They write home, auto, commercial, and specialty lines policies. Also have smaller businesses in the United States, and they got themselves on the map in the UK with an acquisition about 2 years ago. What sets them apart is really sharp underwriting, consistently low to mid-90s combined ratios, and they strive to earn a return on equity that's 500 basis points above their peers. And they do it, 8 or 9 years out of 10. Right now, they're earning about a 15% return on equity. They're also a consolidator of a still fragmented industry, and so they've got the balance sheet and the history and the capability of making accretive and strategic acquisitions. We expect they'll continue to do that. They also benefit from things that are headwinds to other sectors, like climate change, for instance. So increasing weather risk coupled with rising property values leads to higher premiums, and if they keep 4 or 5 cents out of every dollar of premiums, that's bigger underwriting profit. And lastly, the same tailwind that Fairfax is benefiting from, higher reinvestment yields on their huge bond portfolio, is providing a nice kicker to their underwriting profit growth. So a company that we've owned for a long time and continue to own and add to here.
Dollarama is your last idea.
Yeah, so Dollarama, this is obviously a household name. It's ubiquitous across the country, from humble roots in Quebec 20, 30 years ago. It's almost synonymous, really, with the dollar store category in Canada. There's 1,500 stores here. Plans to grow that to 2,000 in the coming years. And really what their competitive advantage is procurement and merchandising that allows them to price extremely sharply. That's never been more important than it is right now, with inflation nipping at everyone's heels. As a result, they're demonstrating like high teens, same-store sales growth. A lot of that's coming from traffic, and so they're picking up new customers who might have traditionally shopped at higher price point retail formats. So there is no stigma to shopping at a Dollarama. If you look, their parking lots, you'll find BMWs, Mercedes, and Porsches. And in this day and age, everyone is a frugal and shrewd shopper, and Dollarama is the place for them. The last thing I'll say is, and this is not as well known, they've got a small but rapidly growing joint venture with Dollar City down in Central and Latin America, with about, I believe it's 400 or 500 stores down there. And these are markets where modern retailing is in its infancy. So that just further accelerates their growth and extends the timeline to saturation even further. in additional geographies. So big free cash flow generator, doesn't require much capital to grow, and should sustainably grow earnings at a mid to high teens rate. So again, we see a good combination of value and growth here, and a very defensible and resilient business model, even amidst sort of murky economic conditions.
Okay, Brian, thank you very much indeed.
Great to be here. Thank you, Andrew.
First idea, Crescent Point Energy.
We remain on the lookout for names that have potentially more than 100% upside. The list is getting shorter because the sector has done fairly well. Crescent Point remains on that list. And so this is a company that has transitioned from Southeast Saskatchewan, low rate, 100 barrel per day oil wells where you'd have to drill like 1,000 of them, several thousand every year to be material, shifting over the past couple of years to be more of a Montney focus. And you've seen other producers do that as well, because the Montney offers similar, if not better, economics, but decades worth of drilling inventory versus years. And so I think the market's just slow in appreciating that change for Crescent Point. I believe we're the largest active shareholder or investor in it today. And what we see is a name trading at under 3 times cash flow at $80 oil and strip gas.
Under 3 times?
Under 3 times. We've got a 2.8 times to forward. We've got it at a 22% free cash flow yield. We're getting half of that now. I still think this is a company that continues to look for opportunities, but even at half, we're getting paid more than 11%. And what's interesting is that they've been using a new frac technique where they're in part of the Montney, where they can really, really go heavy and frac so strongly that they're getting 3 portions of the Montney, 3 layers, all in the same time. So 1 well, 3 layers. And the result is boomer wells. So they recently had one that came on, and it's one of the most economic wells ever drilled in the Montney. This is a Crescent Point. You don't think of Montney when you think of Crescent Point. They think they have 300 follow-up locations that are amenable to that same frac technique. And so you're looking for catalysts that can reframe how people see an opportunity. So we think, again, a mid-cap average of 5 is appropriate. At $80 oil, we get a $21.76 target. That's about 100% upside from current levels.
Cenovus, I mean, this name's widely followed.
Widely followed, and it's been moderately disappointing this year. They had downstream issues in the refineries, which were very, very well known. Management has been assuring everyone that they're fully back online, they're happy with it, so it should be a good quarter that gets reported. Most important to the name is when do they finally, because we've been waiting all year, when do they finally hit their $4 billion debt target? Because at that point, they inflect to returning 100% of their free cash flow back to us. So we think they're going to be just behind CNQ. We have that happening in around January. So we're not that far away. So I look at a name where I've got at least 30 years of long-dated inventory. So there's assurances that the 100%, they're not going to have to go out and do M&A. We look at a name trading at a 15% free cash flow yield. And so theoretically, I think a lot of it's going to be buybacks because the stock is so cheap. But if they wanted to, they could pay us a 15% dividend beginning in January with a bulletproof balance sheet with 30 years of inventory. So to me, that's very, very compelling for a large cap name. It's trading at 4.3 times cash flow. That's a discount to CNQ at around 6. So we think 6 is a good proxy for where Cenovus should trade at. We get a $38.40 target at $80 oil, and at 90 it'd be about 42. So for a large cap to offer 45 to 60% potential upside, where you've got the refineries all working, should be a positive rate of change. You've got good WCS exposure, which we're very bullish on early next year. It's a name we continue to like, and it remains about 11% weight in our fund.
Enerplus.
So Enerplus has always been sleepy, but it's been doing pretty well. So here you've got a name with at least 15 years of drilling inventory in their Bakken play. You get some gas, but I really own it for their Bakken. It's near debt-free, so very, very strong balance sheet. And it's boring in that they've said we will get at least 60% of their free cash flow this year. They've been doing better than that, and we think that continues going forward.
Sorry, say we get 60% of our...
free cash flow coming back in the form of predominantly buybacks.
Oh, shareholders.
So they're buying back stock pretty aggressively. We've got the name trading at under 3 times cash flow next year at $80 oil, so 2.9. We think fair value on this is about a 5 multiple. So that would give me about a $29 target next year, which is 70% upside. So it's boring, it's low growth, they've got a small yield, but it's that action of meaningful buybacks or meaningful enough buybacks that we think eventually drives the re-rating in this name, and that's true of the sector next year. That's going to be the biggest theme, I think, next year, is that balance sheets are going to be like nuclear proof. Their final debt targets are being met in the coming weeks to months to quarters, depending on the name. And it's going to be that inflection of going from 50% of free cash flow to 75 to 100, where you've gone from boring to meaningful. You've gone from people can ignore it to the value proposition now is so unbelievable that the market can't ignore it any longer.
If companies are low in debt, does that mean we'll get a bunch of takeovers? Because that makes them more attractive.
But M&A, there's two problems. When you do M&A, you've got one of two problems that you're trying to solve. One is you have an inventory problem. You don't have enough of it. You want more, or what you have is garbage and you want better. Or you've got a balance sheet problem. If you've got too much debt, you can buy somebody with a better balance sheet and you deliver overnight. We have the sector trading at a 0.4 times debt to cash flow multiple next year at $80 oil.
Really low.
Phenomenally strong.
Yeah.
Like the old rule used to be 1.5 times. Now you're a third of that, and we're never ever going back to the olden days. And in terms of inventory, you've got Montney guys with 15, 20, 25, 30 years, to Tourmaline as much as like 40 years. So you don't necessarily have to do M&A. And you've got oil sand guys like a Cenovus with 30, a Meg with 35, and an Atlassian likely like 40. So I don't see the need for M&A in Canada.
Those reserve lives completely different from the shale players,
Very,
for
very
example.
different, where they maybe have 5.
That's incredible. Eric, thank you very much. I know a lot of viewers would like to have you on every week, if
My
not
pleasure.
every day. And thanks very much.
You bet.
Eric Nuttall.